Just imagine looking at your portfolio and watching 34% of your wealth simply vanish in 5 weeks. That is not a hypothetical. We have lived through market cycles where the numbers drop brutally and rapidly. Try to put yourself in that mental state. You wake up on Monday and your life savings are noticeably smaller than they were on Friday. By Wednesday, the number has dropped again. It is a deeply disorienting experience to watch a screen steadily erase decades of hard work. To make it worse, the external pressure is deafening. Smart people with confident voices are all over the news, pointing at catastrophic headlines and telling you that the damage is permanent. The fear becomes high decibel. It reaches a breaking point where the human nervous system simply cannot process the relentless stream of negative information without reacting. When fear reaches that pitch, your intellect shuts down entirely. I have seen brilliant people who understand market history perfectly well completely abandon their long-term strategies and sell everything they own at the exact wrong time. This chart compares a steadily climbing broad index fund with the actual returns of the average individual investor. Over a long time horizon, research shows a very clear pattern. The individual investor constantly reacts to the market, and by doing so, they trail that simple index by 2 to 3% every single year. 2% might sound like a rounding error, but if we extend that timeline out 30 years, that tiny gap compounds into a massive canyon. We are talking about hundreds of thousands of dollars completely erased from a retirement account. That money is not missing because these investors picked the wrong businesses. It has nothing to do with poor asset allocation. That wealth is destroyed purely by behavioral errors. It is the literal cost of making emotional, high-stress decisions that interrupt years of otherwise perfectly functioning compound growth. We live in a culture that rewards obsession. We assume that the solution to financial underperformance is to work harder, that consuming more data at lightning speed will give us an edge. We applaud the day trader who wakes up at 4 in the morning to check pre-market futures, staring at a wall of screens and reacting to every push notification that hits their phone. But the investors who actually build lasting wealth operate on a completely different principle. I call it the bandwidth rule. This gauge is a way to visualize your mental and emotional energy. It is a strictly finite daily resource. Every time you process chaotic, short-term noise, a bad earnings miss, a geopolitical event, that reserve drains a little more. The opportunity cost of that habit is enormous. Every hour you spend anxiously monitoring the daily movement of a ticker is an hour you did not spend actually understanding the businesses you own. Over-monitoring gives you the illusion of being in control. In reality, it trains the exact psychological stamina you need to survive the next market crash. Now consider an entirely different approach. Some people deliberately restrict their own access to the market, checking their accounts maybe once a month. They take all that saved attention and reallocate it. They study competitive advantages. They evaluate stable earnings. They read wide, sweeping histories to understand how humans behave under pressure. They actively reject financial television and investing forums. They know that environment is far too loud and entirely too focused on the short term to be useful to their goals. Fast forward 15 years. When the inevitable panic hits, this investor navigates the crisis calmly, completely bypassing the emotional exhaustion that ruins everyone else's portfolio. These people are not inherently braver or smarter. They simply build rigid habits of attention that protect them from their own worst instincts. Inaction is usually the correct move for a long-term investor. But let's be clear, there is a massive difference between lazy passivity and the active, incredibly difficult choice to do nothing. To make that choice, you need deep structural comprehension of what you own. Investors like Warren Buffett hold their ground during a crash because they understand exactly how their businesses make money over a 10-year horizon. Second, you have to study human behavior. Markets are human systems. Volatility is just a repeating historical cycle of mass fear and greed playing out on a massive scale. Third, you have to conduct a brutally honest audit of your own risk tolerance. You need to know how you will actually react at 2 in the morning when your life savings drop by 20%. You cannot hold quality assets calmly through a 30% drawdown by accident. It is impossible unless you build that mental infrastructure long before the panic starts. Once you have done that work, you must aggressively protect the mental bandwidth you have cultivated. That means fiercely limiting the media you consume. The financial news cycle is engineered to capture your attention by making every single event feel terribly dangerous and requiring immediate action. That artificial urgency completely contradicts the reality of compounding growth. Real growth is quiet. It has a smooth,
than David. She may or may not be. The reason is that Margaret has protected her decision-making from the single greatest enemy of long-term investing, the relentless temptation to do something. Markets generate noise constantly. Every single day there is a reason to be worried. There is always a geopolitical event, an earnings miss, a Fed statement, an inflation print, a recession fear. If you are paying close enough attention, you will always find a justification for action. But most of that action, most of that buying and selling driven by news cycles and short-term anxiety, is not adding value to your portfolio. It is subtracting it in transaction costs, in tax consequences, in the compounding growth you interrupted when you sold a great business because a bad month made you nervous. The bandwidth rule, and I want you to really hear this, is simply the recognition that your attention is a finite resource. You have a limited amount of mental and emotional energy to spend each day, and where you direct that energy has consequences. Every hour you spend anxiously monitoring the daily movement of your portfolio is an hour you did not spend understanding the businesses you own. It is an hour you did not spend learning about an industry that might create opportunity for you over the next decade. It is an hour you did not spend thinking clearly and slowly about your actual financial goals, your time horizon, what you are really trying to build. The great long-term investors understood this. They protected their attention the way other people protect their capital. They were ruthless about what they allowed to take up space in their minds. Not because they were incurious, but because they understood that clarity, genuine, deep, unhurried clarity, is the actual competitive advantage in investing. Not speed, not access to information, clarity. Now, I want to talk about fear because we cannot have an honest conversation about investing without talking about fear. There was a period not so long ago, many of you lived through it, when major indices dropped roughly 30% in about 5 weeks. Think about what that feels like if you are watching your account daily. You wake up on a Monday and your retirement is worth meaningfully less than it was on Friday. You wake up on Wednesday and it is worth less than it was on Monday. Every single day the number goes down, the news is catastrophic. Smart people with confident voices are appearing on television to tell you that this time is different. This time the damage is structural. This time the recovery may not come. I know people who sold everything in that window. People who had been disciplined investors for decades. People who intellectually understood that markets recover, that downturns are temporary, that the appropriate response to a falling price on a good business is patience or even enthusiasm. They understood all of that. And they still sold because when fear reaches a certain decibel level, intellect is not enough. You need something deeper than knowledge. You need a trained emotional response, a practiced calm. And that kind of calm does not come from checking your account more often. It comes from having spent years building a relationship with your own thinking, understanding your risk tolerance honestly, understanding the businesses you own deeply enough to have conviction through volatility, and choosing deliberately not to fill your mind with the kind of short-term noise that makes panic feel like wisdom. The people who held through that particular crash, the ones who did nothing or who bought more, were not braver than the people who sold. They were not smarter. They had simply built habits of attention that protected them from their own worst instincts at the worst possible moment. That is the real work of investing, not the spreadsheets, not the earnings models. The real work is building the kind of mental and emotional infrastructure that lets you behave rationally when the world is behaving irrationally around you. Think about what that kind of discipline is actually worth in dollar terms. If you had invested $10,000 in a broad index fund in January of 2009, right in the depths of genuine financial crisis, when fear was at its absolute peak, and you had simply left it alone, reinvesting dividends, not reacting, not trading, you would have watched it grow to something in the neighborhood of $80,000 or $90,000 over the following 15 years. Not because you were brilliant, not because you made clever predictions, because you did nothing. Disciplined, intentional, well-reasoned nothing. Meanwhile, the average individual investor underperforms the index by 2 to 3% annually over long periods, according to research from Dalbar and others who track this. 2 to 3% every year may not sound catastrophic, but compounded over 30 years, that gap turns into hundreds of thousands of dollars, sometimes more. And almost all of that gap is explained not by stock selection, not by asset allocation, but by behavioral errors, emotional decisions made in moments of high stress that pulled investors away from simple, patient, long-term strategies that were working perfectly fine. So, where should your attention actually go? Here is how I think about it. Spend serious time understanding what you own and why you own it. Not surface level understanding, real understanding. What does this business actually do? How does it make money? What would have to go wrong for this to be a bad investment over the next decade? If you cannot answer those questions clearly, you do not yet understand your investment well enough to hold through the inevitable periods of volatility. Conviction comes from comprehension, and comprehension takes time and quiet. Spend time reading history, not just financial history, all history. The history of how human beings have responded to crisis, to scarcity, to uncertainty. Because markets are not mechanical systems. They are human systems. They reflect human psychology, greed and fear and hope and regret playing out in real time at massive scale. The investor who understands human nature has an edge that no algorithm can replicate. Spend time thinking about your own psychology. What are your actual financial goals? What is your real-time horizon? What level of volatility can you genuinely tolerate? Not in theory, but in practice at 0 inches the morning when your account is down 20%. These are not simple questions, and most investors never ask them with real honesty. But they are the questions that determine whether your investment strategy is actually suited to you, whether you will be able to hold to it when it matters most. And then, after you have done that work, protect the bandwidth you have created. Be deliberate about how much financial media you consume. Recognize that the financial news cycle is not designed to make you a better investor. It is designed to keep your attention, which means it is designed to make you feel that something important is happening right now, that you need to respond, that inaction is dangerous. That is the opposite of what a long-term investor needs to believe. Inaction for a long-term investor, holding quality assets, is usually not dangerous. It is usually the right answer. This is not passivity. I want to be very clear about that. There is a version of do nothing that is lazy and uninformed and genuinely harmful. That is not what I am describing. I am describing the active, disciplined choice to do nothing, a choice that is harder than it sounds, that requires ongoing conviction and psychological strength. And that has to be earned through the kind of deep understanding I described a moment ago. You cannot hold calmly through a 30% drawdown if you do not understand what you own. You cannot resist the urge to sell at the bottom if you have not already done the work to know at a deep level that the business you own is fundamentally sound. The work comes first. The patience follows from the work. I have been thinking about markets and human behavior for a long time, and if I had to distill everything I have learned into a single practical principle, it would be this. Your returns over a lifetime will be determined less by the quality of your analysis and more by the quality of your attention. Where you choose to look, what you choose to ignore, how you manage the emotional experience of owning assets in a volatile world. Whether you can protect your long-term thinking from the short-term noise that is always trying to pull you away from it. The best investors I have ever studied were not the ones with the highest IQs or the most sophisticated models. They were the ones who had built, through years of practice and self-awareness, an extraordinary capacity for patient, clear, unhurried thought. They had learned to treat their own attention as a precious resource, and they guarded it accordingly. You can do the same. It starts with a simple decision, not a dramatic one, not a complicated one, just a decision to be more deliberate about where your mind goes when it comes to your financial life. To ask before you open that app or turn on that channel whether what you are about to consume will make you a clearer thinker or a more reactive one. To recognize that the most powerful thing you can do for your long-term wealth today might be to close the laptop, take a long walk, and let your best thinking happen in the quiet. The market will be there tomorrow. The great businesses you own will still be doing what they do. The compounding that is working in your favor right now does not need your supervision. It needs your patience. And patience, real, earned, grounded patience, begins with protecting the bandwidth to think clearly. That is the whole game, and it has always been